Well, to some extent, sure, because you think back at the financial crisis and the Great Recession of 2007, 2009, and it kind of rings a few bells, as well as the collapse in the equity markets back in 1987 and some of those kinds of events. But this is different in a number of dimensions from either of those episodes, which, of course, makes dealing with it effectively all the more challenging.
Do you feel like I don't know what you were quite implying there, but do you feel like the Fed chair and the Fed itself has started to show tendencies of caving to short-term market moves rather than long-term economic fundamentals?
Not at all. I think if you take a step back and reflect on this, there's a couple of important things to bear in mind. One is that this is a true shock in the sense that it wasn't anticipated at the beginning of the year or even a month ago. Nothing was priced in because it wasn't anticipated. So this is a true shock. It's obviously a significant negative shock that's going to curtail economic activity, both from the supply side, but with second order and knock-on effects on the demand side. And the other important feature to bear in mind here is that uncertainty is very, very high. And it's very high because we don't know very much at this point about the severity of the virus, how rapidly and fully it'll be transmitted, nor do we know much about how fatal it's likely to be. And so far the numbers, at least to me, aren't that scary. But uncertainty is very, very high. And when uncertainty is as high as it is in this environment, I think you have to expect that markets are going to perform poorly. The economy is going to be hit, and policymakers in these circumstances should respond.
So ultimately, Gary, what's going to be the impact of today's move?
Today's move? Well, today's move, in my judgment, is designed to do a couple of things. First of all, to try to mitigate to some extent the second-order knock-on effects on demand. So if you think about what's happened, obviously the virus originating in China but spreading more and more globally disrupts supply chains, disrupts production, disrupts economic activity, and that's the first effect. But the second effect is, as people curtail travel, as they decide not to go to events where there are large numbers of people, whether they're concerts or sporting events or whatever, if they choose to curtail eating out in restaurants and so forth, those kinds of demand effects are real as well. And I think the Fed's action is designed to mitigate those knock-on effects to the extent possible. We shouldn't kid ourselves that there's going to be some miraculous response because interest rates went down. But it should, on the margin, help. What would also help would be, of course, a reduction in uncertainty, but that's going to take time.